Hey, good afternoon, everybody. I want to welcome you to today's event, Top 10 Stock Pick Sneak Preview. Today is Wednesday, May 10th. You got John Hopkins, Tom Bowley going to jump in a quick minute. Hey, if you're new to Earnings Beats, I want to welcome you. Appreciate you taking the time to join us. Of course, all of our wonderful members, thank you so much for supporting us as you have, many of you for many years. Like all of our events, this particular one is being recorded. So if for some reason you're unable to stick around, no big deal. We'll make sure that you get a copy of the recording probably sometime tonight. Well, this basically is going to be about the top 10 stock picks that will come out next week. And Tom, like everything else, that's going to be interesting. I'll say one thing. Maybe the market's not popping here, but it's sure been stubborn.
Yeah, I think the bulls are really resistant and resilient. Maybe that's a better word. But yeah, that's I'm not surprised. I think the market got pretty sold out. I think we're in the midst of seeing sentiment turn quite a bit. We've gotten we were extremely complacent going into the bear market of 2022. Now we get to the point where we see everybody believing the market can't go higher. Getting back to that daily market report I sent out a couple weeks ago, where that CNBC poll showed that only 24% of the public thought that this was a good time to get involved in the stock market. If the same poll had been run at the end of 2021, I'm sure we'd have seen a much bigger number. Probably 70, 80% probably would have thought it was a great time to get in. So it's amazing how selling and some negativity and bad news completely changes our mindset. At 4,800, the S&P 500 was a great investment, but when you get down to 3,500 and then bounce back up to 4,100, you think it's no way would you want to touch it. So it's just the way sentiment goes, and that's one of the reasons why sentiment's such a great indicator. It's something that we need to always continually look at. But yeah, it's going to be a really interesting next few months because the summertime can be a little bit slower, but we're also coming off of a pretty significant low in the bear market from last year. So my guess is we're just going to continue to move higher and higher throughout the summer. And I think by the time we get around to the fall and the end of the year, we could be pretty close, if not to all-time highs. That's my feeling.
All right, let me go ahead and step aside and let you take it away.
All right, sounds good. Well, let's go through the agenda. Hopefully this will be a pretty quick webinar. I mean, I'm certainly hoping, that we can get through the things we need to pretty quickly, and everybody can be on their way to dinner or do whatever you need to do. But, these top 10 webinars that we do really are trying to focus on selecting, it's a process we go through. It's not just, finding 10 good stocks out there. I mean, we could do that and just ride them forever. Stocks like Apple, Microsoft, it's really about trying to take advantage of the different moods that the market is in. Being in those big cap growth names wouldn't have been so great throughout much of 2022, especially the first half of 2022. But then you get into other times of the year when growth is leading again, and those are great names to be in. And especially the past couple of years, because large cap growth has been doing a lot better than small and mid cap growth. So part of what we do is we try to evaluate the themes of the market and try and figure out, where we believe money is going to rotate. And we try to position ourselves as best as possible by finding leading stocks and leading industry groups within leading sectors. And if we can do that and position ourselves just right, obviously we can outperform the S&P 500, hopefully quite handily. That's been our history with our portfolios, and I'll talk about that in just a minute. But it's always not that easy because the market, especially with the rotation we've been going through, I think the last 12 to 18 months has been particularly difficult for just about everyone in terms of trying to outperform the S&P 500. And you have to keep in mind the S&P 500 is a market cap weighted index. So your large cap stocks are going to heavily influence the results of the S&P 500. So in the market we've been in, large cap has been dominating. So it's great if you've been in large cap, but if you've been in other areas, even in growth, mid cap growth, small cap growth, haven't been doing nearly as well as you might think, even though growth has been outperforming. And I'll show you charts that will help you visualize exactly what I'm talking about. Because going into this last quarter, I mean, right now, I think going into today, our model portfolio was slightly ahead of the S&P 500, but our aggressive was down. And after today, they're probably both down. Well, I know aggressive is down, but model portfolio is probably down this quarter with about a week to go as well. And a lot of it is based on the fact that these mid-cap growth stocks and small-cap growth stocks have not performed very well. But again, we'll get into all that in a little bit. As you can see the agenda, I want to talk just briefly about recent results, keeping in mind that we are aggressive traders. Our portfolios, you should be thinking about them as being aggressive portfolios. Some might not like them because we only have 10 stocks in there. Each portfolio has 10 stocks. A lot of folks don't think you're diversified with 10 stocks. And quite honestly, we're not really shooting for diversification. You know, diversification means getting into all the different sectors. Well, half the sector is going to be out of favor. So by diversifying, I personally believe you're cutting into your potential returns by diversifying. I mean, if you want to diversify, just get into the S&P 500. That's a widely diversified ETF that tracks 500 companies in 11 different sectors all around the globe. So if you're looking for diversification, if you're coming to earnings beats looking for diversification in these portfolios, you're going to be disappointed. That's not what we do. We're trying to find the momentum, the growth to try to outperform the S&P 500. And like I said, over time, we've done a good job. More recently, it's been a challenge. It's been a challenge because of rotation. It's been a challenge 2022 because of a bear market. We don't time our portfolios. We don't say, hey, we're moving into cash. That's a trading concept. We always talk about our portfolios being more like buy and hold, with the only difference is that we swap out stocks every 90 days. So if you're new to this, you have to understand what we're trying to do. Number one, this was originally geared for folks that are interested in being fully invested all the time. That's number one. Doesn't mean you have to follow that. Doesn't mean that you buy all the portfolio stocks and hold them for 90 days. You can trade them. You can ignore them. But for our purposes, what we're doing is we are tracking these over an extended period of time to basically show that what we believe is you can outperform the S&P 500 over time by concentrating investments in areas that are working and then reevaluating that every 90 days. That's the whole idea. Now, before I go any further, I do want to mention, always want to mention, we are not registered investment advisors. I am not providing advice. I am not providing recommendations for everyone to buy. That's completely up to you. We put these portfolios together as a way to, from an education perspective, to show our members how you can put together portfolios to beat the S&P 500. And if we get to the point where over long periods of time we can't outperform, we'll get rid of it. But our results to date since inception have been pretty strong. And when you consider when we started all of this, we started our model portfolio during the trade war. We've since had a pandemic. We've had which was a cyclical bear market. 2022, we've had rising inflation, which created another cyclical bear market. I mean, these last 5 years have not been easy to invest, 4.5 years for the model portfolio. And we've only been doing this for 3 years for the aggressive and income portfolios. We started it in May of 2020, literally almost right on the heels of that, right when we got into the pandemic. I mean, talk about poor timing and trying to put together these portfolios. But I think we've managed to do a pretty decent job considering, I'd say better than decent. I mean, we've crushed the S&P 500 since inception on our two primary growth portfolios, model portfolio, and aggressive portfolio. So it's a challenge every quarter. And what we do is we do these webinars every 90 days to essentially tell members what we're seeing in terms of current themes in the market, where the strength lies in various sectors and industry groups. And then we actually put together what I like to call our war room. It's an Excel spreadsheet where when I go through to pick stocks, I like to list out a lot of things, and I'll show you that in just a few minutes. In fact, I was waiting for a file to come in so I could download it, and that's what I'm going to do right now before we get started here. So just have patience here for 1 second while I get this downloaded. All right. Okay, so let's go ahead and go through the agenda. So I'm going to start off, give you some recent results, show you how you can find those results at our website, earningsbeats.com, if you don't already know. Jump into a few current themes. I'm not going to go crazy here. This isn't going to be like Market Vision, where I'm giving you everything that I can think of as we go into a new year, but just a few things that are kind of intriguing to me that I think are worth noting as you try to put together a portfolio. Then we're going to look a little bit at sector industry strength, how we look at it and how we put together a spreadsheet that kind of tracks momentum. And then I'll show you the war room spreadsheet that we used. I don't think it was last quarter. I think it was the quarter before. I think it was November of 2022. But it doesn't really matter which one I show you. I'll just kind of give you a sense of how I put things together. And then we'll wrap up. Our actual draft will be next week. So if you're not a member, if you like what you hear at this webinar and you want to try us out for 30 days, it would be a great time to try us out for a number of reasons. But one big one will be our draft next week. And so you'll be able to get a little better idea of what we go through in trying to put together our portfolio. All right, so let's jump in. I want to start off with the recent results. So what I want to do is first go into, let's pull up the screen here. So if you go to our website at earningsbeats.com, we try to be as transparent as possible on these portfolios. And so if you scroll down, you'll find an area, obviously, for the Earnings Beats Digest, and I always talk about that. But right next to it is our history on how our model portfolio has returned, the performance of the model portfolio since 2018. We started November 19th, 2018, right before a big drop in December relating to the trade war with China, if you recall. So that wasn't a lot of fun starting a portfolio 1 month before a big 25% drop in the market, but that's essentially what we did. Or 20% drop. I think it was just, I don't think it got to 25%. But anyway, if you click on this for more historical performance, I'm not going to say we update this every day, but it's pretty darn close to every day, at least a few times a week. And what we have on here is our model, aggressive, and income portfolio. Now, I'll be honest and upfront with you. I believe over time that our income portfolio is going to underperform. It has underperformed since its inception, and it will likely continue to underperform. Why? Because we're in a secular bull market where growth leads value. If you want an income portfolio, it's going to take mostly value stocks to put together a portfolio where you're getting a nice dividend return. Your dividend yield as a portfolio, you're going to get the higher yields based on the more value oriented the stocks are. There are stocks like Apple and Microsoft that pay dividends that are growth stocks, but their dividends are minimal. So again, if you're in for the income and not the capital appreciation, then I think you have to be, you have to realize that you're going to be getting into mostly value-oriented stocks. And as a result, in a growth-driven secular bull market, value is going to underperform. It's really hard to pick value stocks, 10 of them, and outperform the S&P 500 when the S&P is being led by the large cap growth names that either don't pay dividends or pay very small dividends. So you just have to accept that as an income investor. If you're in a really good bull market, I mean, we're over the last almost 4 years, and I think I said we started the aggressive and income portfolios in 2020. It was actually 2019. So it was before we went into the pandemic and had that 35% drop. Let's talk about poor timing. But anyway, income portfolio, we've been up 16% since then. It's a steadier kind of a portfolio, so it doesn't have nearly the big ups and the big downs, and it also doesn't include the dividends that have been paid since 2019. So it's just simply capital appreciation of these stocks since 2019, and you can see that that's 16%, and the S&P 500 since that inception is 44%. So if you're looking to outperform the S&P 500, value stocks probably not going to be the best way to go in a secular bull market, which I think we're still in. But look at the aggressive portfolio. Now here, you're going to see very little dividends, but because we have been in a secular bull market, even though we've had some cyclical bear markets along the way, this portfolio is up 96% since we started versus 44% on the S&P 500. That's pretty strong. And if you go back to the start of our model portfolio in 2018, you can see since inception, we're up 133%. S&P is up 53%. So our long-term track record's been pretty good. Now, if you go quarter to quarter, hey, we're not going to beat every quarter. I wish we were that good. But between rotation, themes, sometimes the themes might look like one thing when you get started in the quarter, and within a few weeks, the themes have completely changed. And as a result, the stocks you put into the portfolio are no longer, great stocks to have in there. And we get questions sometimes, well, why don't we just change them? Well, that's great, except are we now going to start building a trading portfolio where we just keep changing stocks in and out? Because that's not what this was originally intended to do. Remember, we've always been a trading, I trade fairly short term. I'm more of a swing trader, but that's kind of our identity, is we're swing traders, short-term traders. And people liked what we did, but they're like, what can you do for us? I'm working all day long. I can't trade in and out of stocks like you do. I'm not following the stock market. I'm at work. Can you put together something where you like certain stocks and we hold them for a while? And that's how these portfolios were born. So understand not only what they are, but what they aren't. They are designed more to be buy and hold for 90 days. And then we reevaluate the market. We put 10 potentially new stocks in. Some might repeat, but probably most of them, if not all of them, are going to roll over. We're going to go into something else. And then we hold those for 90 days and we keep doing that. That's the idea behind what we're doing. So this is a way of at least tracking our results. Now you can see as of yesterday's close, this quarter, and when I talk about this quarter, I'm not talking calendar quarter. We put a little asterisk up here on this quarter, and down here you can see when this quarter is running from. The current quarter is about to end on May 19th of next week. That's why we're having this sneak preview, to show folks in the public what we do, how we put these together. And then next week will be a members only event where we will tell you the 10 stocks that we're putting into each of these 3 portfolios as we go forward for the next 90 days. Now, just to kind of muddy the waters a little bit more, if you look down at the ETF portfolio performance, we do this draft a different month. So instead of doing it in May, we do it in April. We're always a month ahead on our ETF portfolio. And that's why current quarter, this quarter, if you go down here, is April through July. It's not the same. So if you're wondering, because we've had that question before, how come the S&P benchmark this quarter for the stocks is plus 0.98? This quarter for the ETF is minus 0.85. Makes no sense. Well, it does when you realize that they're for different periods. So anyway, I think our track record's been pretty good. You can go into our website. Any member, once they log in, can go in and check out portfolios, and you can go back for every quarter to see the 10 stocks that we put in each quarter's portfolio for each, both for the model, aggressive, and income portfolios. So if you want to go back and look at a year ago, the quarter that we had last May through August, you can do that in our website. We'll show you the 10 stocks that were in that portfolio and how they did for the quarter. So that's a great way to check on recent results. Now, I will also tell you that we track our results, and I'm going to take this down for 1 second, because in our weekly portfolio report that we send to our members every Sunday, we have these year or inception to date charts. So here is the aggressive portfolio. As of last week, we were up 95.87%. Remember that these portfolios start at 100. That's kind of like par. So the fact that this is now up to 195 tells us we're up 95.87%. Over that same period, there's your S&P 500. Now, this was as of Sunday of this past week, or as of last Friday's close. But there was the S&P up 44%. There's the aggressive up 95%. And here are the charts. So you can kind of see what our aggressive portfolio has done. And here is what the S&P 500 has done. And we use this, or we follow this by using the user-defined index at Stock Charts. So we can go in and we can put the value of our portfolio every day based on our calculations, and then chart it so you can see how our portfolios have done. And we've gone through times where we've been absolutely awesome. And this was what I was telling when we got started in the aggressive in May of 2019. Look at the aggressive portfolio get hammered during February and March of 2020 during the pandemic. The S&P, of course, got hammered, but so did we. But if you notice, we bounced back and got back all the losses by the beginning of May. It was August before the S&P got back all of its losses. So by sticking with leading stocks and leading industry groups, we believe over time that we are going to outperform. And again, this has been a pretty rough period we've been in for 4 or 5 years. I wouldn't wish it on anybody trying to develop a track record. Our other portfolio, the model, wanted to show you that one. So this was, again, as of last Friday's close, we were up 131%. So we started at 100. Now we're up to 231.62. And there's your performance of the S&P 500 over the same period. So pretty, I mean, when you look at mutual funds and other portfolio managers, I mean, there are report studies out there that 80% cannot beat the S&P 500. We've got 4.5 years under our belt. I think we do a pretty good job. All right, so that's essentially what I wanted to talk about with results, recent results. We won't know the final how we did this quarter until next week, but we got a lot of ground to make up on the aggressive portfolio. But we also have a lot of earnings still coming out this week. So we'll see what happens through the end of the week. But I know one of the stocks we had in the model portfolio was Airbnb. They reported last night, stock got hit today. So that's going to take our model portfolio down a little bit. And so we're probably trailing on that one now for the current quarter. But we'll see how we finish next week, and then we'll swipe the slate clean and start all over again for next quarter. Next thing I wanted to do, let's take this back down now. Next thing I wanted to do was talk about themes. And with themes, I wanted to just bring up 2 or 3 items that I think are worth noting. So the first one I wanted to bring up was simply interest rates. interest rates are a huge determinant of valuations in the stock market. It's never perfect. There's a lot of variables that go into valuing stocks. It's not as easy as just saying, hey, here are the earnings and here's the interest rate and here's your valuation. There are many firms out there that do have models that they go through. They get their what they think future earnings growth rates are going to be over the next several years, and they discount that back using what they believe is going to be a good interest rate, current interest rate to use to discount those earnings, and they come back with the valuation. And they use that model, and who's to say whether their model is right or wrong? There's a lot of different models out there. But I can tell you, as a former practicing CPA who did valuations, interest rates matter. The thing that bothers me the most about, now let me go ahead and just bring up, let's just bring up the 10-year Treasury yield. One of the things that bothers me the most about people trying to be experts about valuations based on PE ratios. First of all, there are some who take PE ratios, multiply it times the S&P 500 earnings, and say this is what the stock market should be. This is what the S&P 500 should be. That is complete ridiculousness about how to value. And the reason I say that is, are we going to ignore the interest rate environment that we're in? Because if I've got to choose between investments, what I think a company is worth, a lot of it's dependent on what interest rates are. Because when you're looking at the future growth of a business and you're looking at future earnings growth of a business and you're discounting that back, valuations are going to be much higher if interest rates are lower. If you know anything about present value, future cash flows, whatever, future whatever you're looking at, if you discount that back with a low interest rate, you're going to get a higher valuation than if you discount it back with a higher interest rate. Higher interest rates will result in lower valuations. So I look at articles from people that I have a lot of respect for who say, well, PE ratios historically have been this, and this is what they were back in 2000. And so therefore we're at another bubble like we were back then. It's hogwash. You're not even comparing apples and apples. Interest rates in 2000 were 7%. The 10-year Treasury yield right now is 3.45%. 3.44% right here. You're not going to come up with the same valuations. It's not that simple to just take PEs and use the ratios times the earnings to come up with a valuation. You're never going to get the market right. That's why the market is always, volatile, going way above normal PEs and then way below normal PEs, because that's not how the market gets valued. That is probably one of my biggest pet peeves, is using PE ratios as some kind of a determinant of what the stock market should be trading at. Honestly, I'd lose some respect when I see that, because you just don't understand how valuations are done. So there's a lot of things that go into market pricing and market valuations that go way beyond PE ratios. Please don't just look at PE ratios. There are so many companies that have PE ratios of 100, and you look at them, you say, well, I could never pay that for a company. It's way too expensive. It's way overbought. Apple has been one of those companies for years. And so if you use that PE ratio on really good companies, you'll never buy them. You'll only buy the companies that honestly go nowhere. You got to pay up for growth. You got to pay up for the best companies. It's like anything else in life. If you want the best, you got to pay up for it. That's how they get those valuations. They're extremely well-run companies, very efficient, very innovative, and worth every penny that you pay for them. Or you can go out and get some other company that's got a PE of 8. Wow, that's great. And watch it go nowhere. Anyhow, that's a off on a tangent, but the 10-year treasury yield matters. And so anyway, let me pull that back up again on a different chart here. So which way are interest rates going to go? Because that's going to influence what's going to happen over the next 3 months. We've got to make a call. Because I can tell you, if you told me that 3 months from now, the 10-year treasury yield is going to be at 4%, I'm going to have a completely different portfolio put together than if you tell me that we're going to be at 3%. Or even 3.6% versus 3.3%. If rates are going down, it's going to benefit growth stocks. I believe rates are going down. I can't tell you I think they're going to go down every day. They're going to bounce. But I think we've peaked. And the reason I think they've peaked is because I believe inflation has peaked. And I think the Fed's attention is going to turn to the economy. I think all it's going to take is maybe one or more CPI reports at expectation or below, and we're going to see growth explode. We've already seen it explode. I put a chart in our in my daily market report today for members, and I thought it was so telling. Let me see. Yeah, here it is. So let me switch out these charts one more time. Oh, I'll get to that one later. That's not the one I wanted. All right, let's take a look at this. This was a chart I gave to members today in the daily market report. We're going into May, right? Go away in May. Sure, everybody's heard about that. Media will never let you forget about it. It's never going to die. I think it's somewhat truthful and somewhat misleading. But anybody who got out of the market at the beginning of May would say, hey, look at this. I made the right move. S&P 500 down 40, 50 points. Perfect. Well, except that doesn't tell you the whole story. Because a lot of times it's not what's happening on the surface of the S&P 500. It's what's happening under the surface that matters. You need to know where money is rotating to properly evaluate the stock market. People who use technical analysis only on the S&P 500 are missing the boat. There's a lot more information that you're not looking at. Yeah, you can look at the lines on the chart and the PPOs and the RSIs and the moving averages and all that stuff and the head and shoulder tops and all these patterns and blah, blah, blah. But while you're looking at all that, Wall Street is repositioning underneath the surface of what's going on in the S&P 500. And if you don't understand what's going on under the surface, you can't really make intelligent decisions on where the market's going. All you can do is follow what the market has been doing. And that doesn't help you make money. So as we move lower on the S&P 500 in the first 10 days of May, I want you to look at some of our key growth versus value ratios. First one, very simple, NASDAQ 100 versus the S&P 500, QQQ versus the spider. While we're having all these struggles on the S&P 500, is there any question whether or not money is rotating towards the more growth-oriented NASDAQ? I mean, we just keep putting in higher highs and higher lows. How about the IWF versus IWD? That's large cap growth versus large cap value. Straight up. Another large cap growth versus large cap value is right here. This is the Dow Jones US large cap growth versus Dow Jones US large cap value going up. How about mid caps growth versus value going up? How about small cap growth versus small cap value going up? Do you see underneath the surface how money is rotating towards growth versus value? And actually, as I'm looking at this, I realized I'd left out the XLY, XLP, which I always put in here. I don't know why I didn't put that in here. But let's look at the XLY, XLP. I usually put that up there right under the QQQ. So I can add that. And the reason this again is themes. You can look at the S&P and say, well, it's consolidating. It's not really doing much. That's true. And everybody's talking about a recession or possible, and some people still worried about inflation. I told everybody that inflation, all that stuff would die down. That'll go away. All the recession fears, we may have a mild one, I don't know, but it's all going to go away. It's temporary. The beauty of a recession, and what most bears don't realize, is that if we start getting signs of a recession, guess what happens? The Fed starts lowering interest rates. What does that do? It increases valuations. So while you might get a quarter or two of some, maybe not so great earnings reports, interest rates come down. It's an offset to the weak earnings. Now all of a sudden valuations go higher because of lower interest rates. Anyway, here's that XLY XLP. So throughout May so far, money's rotating into discretionary versus staples. So we can look at what's on the top of the surface. It's like looking down on a big body of water and saying, well, it doesn't look that deep. And then jumping in and drowning. It's, it only gives you so much perspective by looking at the S&P. You need to be looking underneath. Money is rotating rapidly into growth. And what have I said about growth? I've talked about this seasonality. Look at, we could pull up just about anything, but let's look at seasonality QQQ. And I'm going to do this versus the spider. So when does the QQQ outperform the S&P 500? Let's go back 11 years because this is back at the start of the bull market. 2013 is when the S&P finally took out the highs from 2000 and 2007. That's when we confirmed a breakout. In my opinion, that's when the secular bull market began. Not back from 2009 at the low, because we didn't know we were going to break out. We could have gone back to 2003 at the low, right? But the bear market didn't end then. Why? Because we never got the breakout. 2007, we got up right out to 2000, turned back down again. Who's to say after 2009 that that's all we're going to do? Go back up, test it high, and move back down again. You don't know it's over until you get the breakout. 2013 is when we had the breakout. So this is what I look at for the secular bull market. This is when we moved into all-time high territory, and we kept adding, putting in higher highs, higher lows for the last 10, 11 years. During this period, when has growth led value? Now, the QQQ is mostly growth. I'm not saying the spider is value. Spider has Apple in it. Spider has Microsoft. The S&P has a lot of growth-oriented stocks, but it doesn't have as many. It's not as highly or heavily represented by growth as the QQQ is. So when you're looking at these two relative to one another, when growth is in favor, the QQQ should outperform. And so I've shown this before, but you can go across, you can add the average monthly outperformance of the QQQ versus a spider and go across right here. But after you do that, I want you just to add the 4 months, May to August. Add another 0.3, that's 1.3. Add 1.7, that's 3.0. Add 1.2, that's 4.2. May to August, over the last 10, 11 years, growth has outperformed value by 4.2 percentage points, which is the majority of the outperformance throughout the entire year. Let's see, it's 4.2, I guess 5.2, 5.4, 6, 5.7, 5.3, 5.6, 4.9. So the entire year is 4.9, 4.9% outperformance, 4.2% during the next 4 months, including May, this month. So that's like 85% of the outperformance, growth versus value, is in these 4 months. So when we start off May and the S&P is not doing anything, but we see all these growth ratios going up, what do you think Wall Street's doing? Do you think, are they on CNBC talking about this? I mean, I don't watch it, but I'm going to guess no. I mean, first 10 days of May, has anybody seen CNBC? I know, John, you watch it. Has anybody been talking about how May through August is a great time for growth stocks? Again, I'm going to say probably not, because they're not there to educate you. I mean, it really is a game with Wall Street. The good news is we have all the information we need to compete with Wall Street, but most people don't know how to do it. And they turn to CNBC for their education. That was a sigh, because it is very annoying to me. Because they're not about research and actually providing you education that you can use to better your financial performance. They're in bed with Wall Street. CNBC, a lot of their revenues come from those big Wall Street firms that are paying for ads and all those appearances on CNBC. CNBC is their little puppet that they can use to manipulate the public. That's what I think. And if you disagree, that's fine. It's just my opinion. But I think we've become so media driven. You know, it used to be that we had news. I don't really even think we have news anymore. I mean, we just have a bunch of opinions, and a bunch of opinions that are swayed by their own personal beliefs and choices. And I don't listen to any of it. I literally come up with all my own thoughts, research, opinions, and I am best at predicting the stock market if I tune everything out. Because as soon as you start listening, I mean, I can go right down that rabbit hole just like everybody else. As soon as you start listening, you're like, wow, that does sound kind of bad. And, you know, you can paint so many pictures. And I think sometimes it's best if you try to be objective and paint your own. But here's the QQQ versus Spider. How about we do IWF versus IWD? We'll do the same thing. So let's pull up that relative, go back 11 years, and let's add them across. 8, 1.0, 2.0, 1.9, 2.5, 3.4, 5.3, 7, 6.3, 6.2, 5.8, 4.9. 4.9% going across all 12 months. May, June, July, and August, 1.5, 3.4, 5.1. So the entire year, large cap growth versus large cap value goes up roughly about 4.9%. That's how much growth outperforms value at that large cap level, 5.1%, or 4.9%. But in the months of May through August, it's 5.1%. Effectively, all of the relative strength in growth versus value comes during these next 4 months. And yet, what do you hear all over the media? Go away in May. I scratch my head. I do all of my independent research, and I'm like, that's not a true statement. It's true from a broad perspective, because the stock market has done better from November to April than it's done from May to October. That's a proven fact. My numbers support that theory in total. But it's only given part of the truth. Growth stocks, which is one of the biggest areas to benefit your portfolio over time, the best 4 months during this entire secular bull market that we're in right now has been May through August. And yet, nobody talks about it. How is the investing public going to know about it if nobody talks about it? Well, I don't think Wall Street wants us to know. Do you think Wall Street doesn't know that May through August is big? That's the summertime. Everybody go away in May. People start selling, building up cash. And meantime, while everybody's selling, Wall Street's buying, hand over fist. And again, we're seeing it right now at the beginning of May in that chart I showed you. So seasonality, I mean, this is another part of themes that you need to be aware of. And the last one I want to show you is I want to show you the equity only put call ratio. So just keep in mind, I don't really want to get into this. I've talked about this numerous times, but a lot of these readings back in November and December were not, it's not that they weren't accurate. They weren't giving us the information we needed. There were big hedge funds that were placing large equity put orders in on some of the big NASDAQ names, Apple, Amazon, Microsoft, Tesla, NVIDIA, maybe a few others. But that's not what I like to look at the equity only put call ratio for, because usually professionals, if they're going to play options, they normally do it with index options. They don't normally go to the individual stock level to start playing puts and calls. And so normally this chart is driven by the emotions of the retail trader. That was not what was happening here. These were crazy readings that really threw off the real intent of what we try to use the equity only put call ratio for. So when we go through this, I mean, anything dealing with November and December of 2022, I just ignore, because, and there's only like 10 or 12 readings in here that were off. You can see the spikes. I've read one article that said it happened a lot on Wednesdays, and I looked and some of these were Wednesdays. But anyway, what I want to show you is where we were with sentiment heading into 2022 when I said we need to be really careful about the stock, with the stock market going into 2022, and where we are now. I think it's a good representation, even if we do include these numbers. Just remember that the numbers will be a little bit overstated. So what I want to do is I want to go down here, and instead of showing candlesticks, I want to show invisible. So all the daily information is gone. And if I just click on that, all you'll see is the moving averages, right? Well, except these aren't the moving averages I want you to see. What I want you to see is first a moving average, 253-day simple moving average. The other one I'm going to get rid of. And I always look at this as like the Freightliner of sentiment indicators. It takes a while to turn a Freightliner. You get one of those big Freightliners out in the ocean and you want to turn it around. It's not like steering a speedboat. A speedboat, you can just turn on a dime and go right back the other way. You get one of these big, large, Freightliners, it's going to take a little while and a little effort to kind of turn the corner and go back the other way. They're not built to make those turns real fast. So what I want to concentrate on here is looking at this relative to the S&P 500. And actually, I probably have a way that I've already done this. Oh, I'm in the wrong account now. Let me go back and pull up those other charts for you. And I think we can find this a lot quicker. Should be able to just pull this out of the Market Vision event last year. Actually, if we do 2022, I can pull this up. Yeah, this is the one. So at the beginning of 2022, what I told everybody, and this was the first week of January, I said, this is the 253-day moving average of that equity only put call ratio. And when it's going down, it means that folks are turning from being very pessimistic to maybe to the point of maybe complacency, too optimistic. But while we're doing that, before that Freightliner can turn, notice when we're going down, the stock market explodes to the upside. We're going down, stock market explodes to the upside. We're going down, stock market explodes to the upside. We're going down, stock market explodes to the upside. Going down, stock market up to the upside. Now, what happens when this Freightliner turns? And all of a sudden, we've gotten too complacent. Think about that for a minute. From a sentiment perspective, too complacent in this case means people are buying too many call options. They're getting to the point where they think the options market is just an ATM machine where they can just buy an option and it just goes up and you just make money and life is good, life's easy. Usually that doesn't end well. And by not ending well, I mean, we start turning up. and the Freightliner goes in the other direction. And when this Freightliner is going up, look at what happens in the stock market. Here we were down 50%. Here we went up. It wasn't bad, but we didn't go anywhere. It looks like we went down about 4%. Going up, here we were flat. Going up, there was a little choppiness right in here. But look at what happened at the beginning of 2022. If you're a member and you were at that Market Vision 2022 event, you know that I said the biggest problem with the stock market in 2022 is sentiment. And we were just starting to turn up on this Freightliner. And when this is going up, you don't want to be in the stock market. Or you certainly shouldn't be expecting a whole lot of good to come out of it. And this is what happened. Just like every other time that we've had this going up, it's not generally a good time for stocks until you get to the point where you roll over. We haven't gotten there yet, but remember, those November and December readings were a little bit higher. They're skewed. I have a user-defined index that I'm tracking. I'm at about 0.69 right now, and it's still going up. But one thing you have to realize is that I have all the data going back for the last year, and things really started to turn bearish in May of last year after the market had already done all of its selling. That's the thing people just don't get about sentiment and why it's so powerful. Market participants during the first 4 or 5 months of 2022 kept making excuses. While the market was going down, they still believed we were in a bull market. And it wasn't until they got beaten over the head by the media for 5 months about how bad things were that they finally started to start turning bearish. And now the market's going up and they don't understand it. How can it be going up when everything's so negative? That's the way the masses are, and that's why this chart works. So down here, nobody believed the market could go lower. And so what happened? It went lower. And as it went lower, the Freightliner turned and trended higher as more and more retail traders grew more and more bearish. Look, it's still going up. We bottomed in October. And yet, just like I said in my daily market report a couple of weeks ago, CNBC had a survey that came out and said 24% of people think this is a great time to get in. They don't have perspective. They don't have a way to overlook the news that they're hearing. If you want to be really good in the stock market, you've got to be really good about understanding perspective and understanding sentiment and what sentiment does for us. Because I know, it doesn't look like it yet, but I know the high readings that started in the latter part of May and went through June, July, they are going to be replaced by lower put call ratios. And when they do, this is going to roll over. And I believe it's going to start later this month. And so, again, once we start to roll over, if you look at every decline that we have had, tell me how this one's going to be different. Once you've gotten to the point where everyone's bearish, doesn't that essentially tell you that everyone's sold? You listen to everybody that's so bearish, pounding the table, the market can't go up, can't go up. What do you think they've done in their portfolio? Do you think they're still sitting 100% long? No, after a while, everybody who wants to sell has sold. We're going to roll over and the market's going to take off. I think it's already started, but I think we're really going to get strength later, second half of 2023 and into 2024. There is very little doubt in my mind that by the first quarter of 2024, we're not setting new highs on the S&P 500. I'm pretty much convinced of it at this point. And that's only 9 months away, 8 to 11 months away, something like that. But we'll see. I think those that have wanted to sell have sold. the Fed done raising rates. I think the market going up right now was because we've been anticipating the Fed stopping their rate hikes. The market looks ahead. Everybody said, I get a lot of feedback. Don't fight the Fed. Market can't go up. Fed's raising rates. I've pointed out, when they started raising rates, their first big rate hike was in May of last year. The bottom was in June. I mean, we went a little bit lower in October, but essentially the bottom was in June. Before almost all the rate hikes, the market had already priced in all of that. And then folks are coming out, well, you can't fight the Fed. Well, yeah, I think the market's already taken it into account, so I'll fight the Fed. Again, it's so much more about listening than listening to CNBC and just looking at the surface of the S&P 500. There's a lot more that goes into it, and this is a big theme, a big part of what's going on with sentiment. So anyway, we're getting ready to head into 3 months, the next 3 months, where I believe growth is going to continue to be dominant. Maybe the second half, maybe I'm going to say, July, as we go into the next earnings season, I think July into maybe the early part of August is where we're going to see the most strength in growth as we prep for another earnings season. And I think the further we get along, the closer the market's going to get to lower interest rates. And I think that'll start being factored into valuations. And I think you're going to see some stocks starting to put in some highs that are going to be shocking people. You're going to see Apple at all-time highs, Microsoft all-time highs, NVIDIA all-time highs. Go right down the list. Probably going to take a little while for Tesla. But somewhere down the road, Tesla will be back to all-time highs. And unfortunately, it gets harder and harder to get in when you miss more and more of the move. But history tells us that the bottom of cyclical bear markets, bottom of any bear market, the first 12 months after that are your best opportunities to make money. And that goes through October of this year. And that's why I believe we're going to see between now and then a pretty good sized move. I still believe we're going to be somewhere in the upper 4,000s by the end of the year. I think I predicted 4,700 back at the beginning of the year. And I believe we'll be there. I don't see anything's changed my mind at this point. So when you put together portfolios, that's obviously something I got to keep in mind. If I'm bullish and I think growth is going to outperform and I think rates are coming down, that's going to dictate the types of stocks that I'm going to want in the portfolios. And you know what? And this is what I always say, if I'm wrong, at least I know why I'm wrong. I called the themes wrong. If I called the themes wrong, then okay, then I'm wrong. But you've got to have some conviction. You got to have something that you believe in. Otherwise, the market makers are just leading you around by the nose. All right. So the last thing I just want to talk about is the big thing is sector industry strength. And what I do is I will look out to like, well, let me pull up my relative strength sectors. So this is a weekly chart of each sector relative to the S&P 500. This is technology. Anytime you've got the relative PPO above the zero line, it tells you that on a relative basis, you have bullish momentum. Technology clearly is bullish right now. I mean, it's really, if you wanted to try and argue, you can, but I mean, we're sitting at an all-time relative high right now, or just about there. It's really hard to argue bearish thoughts about technology. I don't know how you can. Consumer discretionary improving, but not above zero yet. So we still got some work to do with discretionary stocks. That I will readily admit. Although what I'm seeing in terms of intraday strength in consumer discretionary, that's much better than just including gaps, because that's what this is doing. If we gap down, that's factored into this. The chart that I like to follow, the user-defined chart that I've established, is looking at the XLY versus the XLP, but only on an intraday basis. I ignore gaps. And the story that that's telling, this is showing XLY coming down relative to the S&P. And if you look at the XLY versus the XLP, it'll show the same kind of a chart. It's been coming down. Intraday, my relative chart does not show that at all. It shows going up and sideways consolidating, no going down. I haven't seen much of anything going down on the XLY, XLP. And that's why I think we're being manipulated at the opens. Wall Street, big firms don't put market orders for 1 million shares in at the opening bell. It's not how they get out. They don't get out on the opening gap. There's not enough liquidity. They have to sell during the trading day. Distribution, accumulation takes place during the trading day. It does not take place in overnight gaps. So you need to, at some point, have selling during the day. And we had that. January to May of 2022, we had, without a doubt, selling at the open, in the morning, at noon, in the afternoon, and into the close. Consistent selling for 5 months. And I've shown charts and pointed it out. Since May of last year, there has been a ton of accumulation with lots of gap downs, lots of morning weakness, and then tons of buying. And that's Wall Street. That's the big Wall Street firms getting in while everybody else is panicking out. And by the way, those same Wall Street firms control CNBC. So you be the judge what's been going on. I said during 2022 that we were being manipulated tremendously. And I believe that even more in 2023. There's no one that could prove to me otherwise. I think we have been tremendously manipulated, basically coerced into selling shares based on all the media news out there. Then the folks jumping in the morning, which is what I consider amateur hour, from 9:30 to 10, or maybe even to 10:30, 11. And then from 11 o'clock on, after everybody's done selling and can't take any more pain, and folks are shorting because all the retail traders think we're going lower as well, which is awesome. I mean, it's not awesome because a lot of people are losing money, but it's awesome if you're knowledgeable because you realize they're the last ones to kind of get it. Wall Street's been accumulating all day long, and now we see the market going higher. And you know what? Once their accumulation's complete, and may be complete now, during good markets, we get gap ups, not gap downs. And that's going to make it very difficult for folks to get in because people don't want to chase a gap. And so they're like, well, when it comes back down, I'll get in. When it comes back down, I'll get in. And it never comes back down. It's the way the market works. Anyway, XLY, it's got some work to do. XLC, look at communication services. During 2022, and even the quarter before, it was horrible. But it is coming back with a vengeance. Internet stocks are on fire. This is showing you that these stocks in the XLC are crushing the S&P 500 and have been since the end of October. You can fight it or you can simply ride it. And then you get other areas where energy was really strong. Remember, look at the relative PPO going negative for the first time in about 18 months. Money's coming out of energy. It continues to come out of energy. Materials, same thing. Look at it dropping. Look at that relative PPO negative. And as you know, some are saying, well, yeah, staples have been doing better. Well, they've been doing better, but they're way off the high from the beginning of the year. I mean, I would say that the uptrend's been broken. And if I'm right about the market going higher, staples, that's not the area it's going to lead. This is going to roll back over. And then you've got other defensive groups like utilities, real estate. I mean, utilities been drifting lower since September of last year. Real estate's been drifting lower for longer than that, since April of last year. I mean, it's near a multi-month low. Money's been rotating out of defensive areas and into aggressive areas. It's been happening for months now. I've been talking about the accumulation that's been taking place during the trading day. These are all signs of a market that wants to go higher, not lower. So you can choose to listen to everything you're hearing on CNBC, or you can just simply look at the charts. and let the charts tell you what's going on. So I'm going to be the one to follow the charts, to follow my research, to follow my instincts, to follow perspective. All of those things matter. Now, in addition to this, I'm also going to look at the industry groups. And one of the things you'll see, I'm going to show you an Excel spreadsheet in just a minute, and that's going to be the end. We'll wrap up. But look at this relative PPO right here. Been going straight down. This is computer services group. Now we can go through every group. Here's semiconductors. Look at this one. I mean, when you get up to 3.5 on the PPO, weekly, the relative weekly PPO, 3.5 is pretty high. It's because semiconductors have been leading, and that's actually pulled back some. We were up to 5 6 weeks ago. We've actually seen some relative rotation away from semiconductors. And when semiconductors hit their big support level, that's when I told members that's a good time to think about getting into like the triple semiconductor leveraged ETF, SOXL. I mean, you want to do it, you don't really want to chase. Leverage can get painful if you catch a top and you're on the long side. That can really be painful to be riding it down 3 times. But when it comes down and hits support, when the group comes down and hits a support area, that's when you want to be thinking about getting in and then riding the next wave to the upside with the leveraged ETF. But semiconductors have been strong. So do you think I'm going to be favoring semiconductors in the next portfolio? I can promise you I will. Semiconductors will be a big part. Software is one that, this one hasn't been, it started on a relative basis to pick back up again. But overall, throughout all of 2022 and even to start the beginning of 2023, software was horrible. You didn't want to be in software. Now you can see that starting to change. So software certainly would be an area that I'm going to be interested in as well. I've been looking at areas like specialty retail, where we're positive. We pulled back a little bit, but it looks like it's starting to turn back up. And if you notice, specialty retail just broke out relative to the S&P, this little sideways range that we were in. We're starting to turn back up off of that. So what I do, and now I'll show you the spreadsheet, because when I start looking at selecting portfolio stocks, I want to at least be considering the strong groups. So let me see. So here is, this is a chart or a spreadsheet that I told you earlier I would show you. But this was as of November last year. So this isn't current data. But what I do is I track the momentum from each of the quarters and just kind of, glance across and see what the weekly PPO was then, what it is now. And I try to favor the areas that are showing increase in relative PPOs, because that tells me that momentum is building from a technical perspective. The other thing I do is I put the next few months seasonality out here so that I can get a good read. Here, November, if you think about the portfolio, you come in at November 19th. So you have about 1/3 of the month of November, all of December, all of January, and then 2/3 of February to get until February 19th when we'll, do another draft. So I take 2/3 of February, 1/3 of November, and I take the full December and January to come up with this percentage over here. And then I can just look and I see, oh, well, the beginning of the year, communication services was an area that tends to do really well from a seasonal perspective. Well, guess what just happened at the end of remember I just showed you communication services took off at the end of 2022 and in the beginning of 2023. That's what seasonality told us. So you're kind of looking at these different themes. You're looking at momentum. You're looking at the individual, you're looking at the sector relative strength charts, the industry group relative strength charts. We're looking at seasonality. We're starting to form in our mind what areas that we really want to try to focus on to try to find some leading stocks in. And then it's all about pulling up actually what I consider to be the war room for the draft. And that's where I put up all of the industry groups for every sector. So here's all technology, here's all discretionary, and I go down and I do it for every one of these groups. And then I actually go to the strong earnings chart list and I list the highest scooter scores in each of these industry groups off of that strong earnings chart list. And I'll usually take it down to, from the upper 90s on the scooters all the way down to maybe 70-ish, maybe 65. If the scooter is much lower than that, I probably don't need to look at it because it's not showing enough relative strength. But that's how I go through and I look at every single one of these charts. And I try to decide, here, strong season, I was just, putting in here just so I would be reminded that, hey, these are the groups that tend to be strong seasonal performers. I mean, as we went into the beginning of the year, look what was on this list: gambling, home construction. If you look at those two charts, you'll see beginning of 2023, they were going straight up. So we need to be aware of the groups that tend to perform well during various periods of the year. And then we look for leading stocks in some of those groups. That's really what we want to try to do. And then at the very bottom, after I put them all together, and I track it by number of stocks within each sector. Because if you remember, technology is about 27% of the S&P 500. So if I'm putting 10 stocks in a portfolio, I probably need 3 in technology just to kind of represent the technology group in the S&P 500. If I only put 1 technology stock in there, I've only got 10% of my portfolio in technology. Well, the S&P is generally led higher by technology. If I think the market is going up, I'm probably going to want to think about maybe doing 3 or even 4 technology stocks in my portfolio. Discretionary, kind of the same thing. You think about, is that a group where you want to put some additional focus? Communication services, do you want more than just, 1? Or do you want 1? And I go through every sector like that. It's a lot of work. I spend the whole day, basically, and sometimes the night before, putting all this stuff together, going through, looking at all these charts, and basically coming up with the 10 stocks. I jockey them around between portfolios, especially sometimes between model and aggressive. If I have 2 and they could go in, 1 could go in either one, then normally smaller mid-cap type stocks, I would be putting more of those into the aggressive and maybe a little bit more of the larger cap like Apple, Starbucks, those kinds of names would be in the model. But that's just a general guide. I mean, here we had 2 internet stocks, one Netflix, the other Sprout. I think it was Sprout Social, something like that. But one is clearly the big dominant player, Netflix. The other is a little bit more obscure, a little bit more aggressive. And so it went into the aggressive portfolio. But that's essentially how I put these together. So a week from today, or actually I think it might be a week from, I'm not sure when that webinar is. Do you have that, John or Aaron or anybody listening in here? When did we schedule that portfolio draft for? I know it's not the 19th. It's either the 18th or the 17th. It's either next Wednesday or Thursday. But anyway, I'll be happy to answer questions, John, if we have any questions.
That will be Wednesday, the 18th.
Okay, so the actual draft is a week from today.
Yeah.
So if you like what you heard here and you're interested in finding out how we put together these portfolios and which stocks we picked, 30-day free trial gets you in. If you haven't tried our service, why not try it? I mean, there's nobody that's been calling the market better than us. And I'm not, trying to pat myself on the back, but it's just truth. We called the top in 2022. We have members that have written in that got out of their retirements or put everything into cash because of the caution that we were talking about at the beginning of the year. And then when I called bottom June, after we'd gone down 25%, They put it back in. We had one member who said he's been doing nothing but listening to our calls and getting into the triple leverage in and out, and he's doubled his portfolio since June of last year. Doubled. So I know there's a lot of pretty happy, satisfied members of Earnings Beats. And if you haven't tried our service, or even if you have tried it, you want to give us another shot, we'd love to have you. Check us out for the next 30 days. We got a lot of events coming up, and I think you'll have a really good handle on what we do, and hopefully really like the guidance that we provide. If nothing else, you'll get our daily market report the next 30 days, keep you kind of up to date on what's going on, what I'm seeing in the market, and then you can make a real intelligent decision another month about whether or not this is the type of service that you want to be part of.
Question sort of related to, warning signs, and particularly this individual saying you correctly predicted the market down at the beginning of 2022. Great job. Did you have any warning prediction signs on the market that it might be in trouble at the beginning of the pandemic? So in other words, before things totally fell apart.
No, in fact, all my signs were suggesting that it was going to be short-lived, which it was. I mean, it's really hard to predict a pandemic. We've had one in 100 years. So I don't think that's a great thing to be trying to predict. But that was, I don't fault anyone for not predicting the pandemic. I mean, I don't know that it's possible. We started hearing cases, I believe, early in 2020, maybe in January, that were surfacing from China, but they thought they had it under control. And then we saw a couple cases start popping up in other parts of the world, and nobody knew anything about the virus at that point and how much impact ultimately it would have, mostly from a healthcare perspective, but also short-term from a financial perspective. Driving people out of jobs, and all of a sudden people sitting at home more and trying to figure out ways to make money. I mean, I think we lost, I forget how many jobs, 20-some million jobs in a month or two when the pandemic first set in. I don't know how anybody can predict that. So no, I mean, the answer is no. There's no way for me to have predicted that. But what I can tell you is I have an article time stamped over at Stock Charts I wrote on March 13th to 2020. And while everybody else was calling for the Great Depression 2.0, I said, this is a cyclical bear market, and we're going to go right back up when it's over, and it's not going to last long. And people thought I was nuts, but another month or two, we were right back up, got all of it back. So I think the guidance that we provided during that period, even though, we certainly didn't predict the top, we didn't say get out and get back in 35%, after we dropped 35%. I think our guidance to stay the course and not be chased out of your positions, I think that turned out to be the right one.
All right, really the last one. Let's wrap up. Somebody just asked if you have any comments on the price action today.
Well, one day is one day. A lot of the signals I like to look at are formed over a period of time. So, I don't take too much out of one day's action. I mean, but I like what's happening. I mean, I'm bullish. I think everybody who knows me knows I'm bullish. I've been pounding the table starting June of last year, and I really haven't let up. That's the thing for me. When I think we're in a bear market, all the rules change. I don't buy on pullbacks. If I think the market's truly in a cyclical bear market or a secular bear market, if I'm doing anything, maybe it's around max pain. I might try to catch some stocks moving back up. But I actually did well during the 5-6 months of the cyclical bear market when going down to that June low by waiting for bounces and getting into the leveraged ETF, inverse ETFs. So that was the way I personally made money, was just waiting for the bounces and shorting. And if I happened to be in cash and the market was going down, I was fine with that too, because my purchasing power is going up. So what I try to do in a bear market is simply keep my capital intact as best I can, or maybe even grow it. That's even better. But once I think the bottom is in and my signs tell me the bottom is in, there's no more shorting for me. None. I don't care how bearish everyone else is. If I'm being told based on my signals that there's a lot more risk to shorting than to going long, then I'm going to go long. And if I'm wrong, I lose money. I'd rather lose it on the long side. What I hate personally, that makes it, from my perspective, the thing that really is difficult for me to deal with is when I'm bullish and I short and I lose money because the market goes up. It's like, wait a minute, I'm calling for the market to go up. The market's going up and I'm losing money. That is psychologically the hardest part for me. So, and I've found that over the years. So I don't try to short in a bull market. If I think we're topping, I've sent out some things to members in recent weeks. When we get up close to a resistance level, I say, hey, I'm getting out of my leverage. I go back into the QQQ, but I get out of the QLD or the TQQQ because we're at resistance. If we keep going, great, I got the QQQ. If we pull back, I can always flip back out of the QQQ and back into leverage. So that's the way I deal with the current action. Is I'm bullish. Right now, I'm just QQQ. Got a few individual stocks here and there. One that I bought today was Alta. That stock had been beaten up and had a really nice recovery. There was the low that we saw back in March. It went down just below it. I love these false breakdowns on healthy stocks. This is a stock's been uptrending for a while. You have 2 bad weeks. And now all of a sudden we're at a multi-month low, went below it. And I bought right at this low, right at 501, figuring that if we finish strong, great, I'll hold on to it. And if we weaken and we finish below 500, we break down at the end of the day, I'd get out. So far, it's held. We'll see what happens from here. But that's one. Another one that I've been talking about, or that I talked about recently, that I really like and I do own, is Zimmer Biomet Holdings, ZBH. I love this action today, where it looked like it was breaking down. The market was actually up today. And I was looking at this stock and I was thinking about selling it. I'm like, well, let me see where it closes today. And look at that rally. Volume picked back up a little bit and we came back up and put in a higher high. That was the first time we've had a higher high on the stock in about 5 or 6 trading days. So that to me looks like maybe a reversing candle right on the 20-day moving average. So there are individual stocks that I'm in, but I'm not in many. And I've got, I've been trading a little bit with the short squeeze stocks. Did pretty well. I got out of Vuzi today, but I, made money with that one. That's VUZI. Made money this morning with Carvana. I got out way before it went much higher after I got out. But you can see another big day on Carvana. Certainly looks like that short squeeze is still fully in play. NVAX, I actually traded again today because it went down and hit the gap support. Look at the intraday. I literally didn't play it for very long. But right here, look at that gap. It went down and hit this gap support, and I literally bought it $8.99 today. Figuring, okay, if I get a little bit of a pop, great. If it goes down any further, if it had gone down a dime, I would have been out. But instead, I got a little pop. It started to roll over. I got out. I took like 20 cents. And even the close today did hold right around that $8.99 level. So I think we're still okay on that one. Although I want strength in my short squeeze stocks. When you look at Carvana's chart, this is one. It's the most heavily shorted stock in the market right now. And look at that. It just keeps going higher and higher. And it's got to be starting to drive some shorts crazy, because every time it goes up, that was another 11% today. Shorts are going the wrong direction. And they may be forced trigger, if any other good news comes out on Carvana, I could see the thing opening at 17. I don't own it right now. Again, I'm a little bit conservative even when it comes to short squeeze stocks. I like to try and make my money and get the heck out. But no, I think the short-term action has been great. Look at the QQQ today. Looked like it was falling apart. What have we been talking about for the last year? 2 o'clock to 4 o'clock has been an unbelievable time for the stock market. Right about 1:30 is where the bottom went in, and we saw buying almost all afternoon into the close. It's hard not to like that action. So no, I'm bullish the market. I'd like to see more participation. I'd like to see the S&P 500 breakout, get through 4179. We definitely still have some room to go to get there, but we finished at 4137. We have 42 points left. It's 1%. So we need a move on the S&P to move up. I'd like to see the NASDAQ leading, but I also want to see the S&P 500 breakout as well. But
Hey, Tom.
overall market great. Yeah.
I know it's not individual stocks, but somebody's asking, you're talking about short squeeze, Beyond Meat reported after hours, got as high as 14, but it's pulled all the way back to like 1290, still up 5.5%. What would get you excited about a potential short squeeze?
Well, I mean, this one, I actually was watching it a while today. It did come back up a little bit at the close. But I mean, the problem I have with Beyond Meat is it's going to take a little bit to get the shorts going to want to cover. Because if you look at a daily chart, I mean, if you're shorting this thing, do you feel any pressure, any need to cover? I mean, all you're doing is making money almost every day by being on the short side. So, I mean, yeah, it gets up to 14 on a 20-day moving average is sitting at 1354. I'm going to need to see a strong finish, not necessarily a strong after hours, but I'd like to see this thing gap up. And you have to think, okay, when it gaps up at the various price levels, where does it really begin to put a lot of hurt on the shorts? And I would argue, I mean, when it really puts hurt on it, would be when it breaks out above the February highs. If you get through 2021, that is where every single person that has shorted for the last 8 months will be underwater. That would be a big level. Between here and 20, I mean, we could pick out some levels. I mean, it looks like 15 was pretty good support. We broke below that. So maybe getting back up through the 50-day might create some buying, but let the market tell us. I mean, that's the one thing with these short squeeze. What we do with the short squeeze charts is we have a chart list. It's got 47 names on it right now. And the charts that we use, I've got this 50-day simple moving average of volume. Is there any doubt that we're trading well above normal volume on Carvana? Normally, the volume averages 14.9 million over the last 50 days. Today, 41 million, and that was the lowest level in the last 4 days. And we're still triple the average. That's what you want to see with a short squeeze. It's not moving up a day or two. That to me is not a short squeeze. And a lot of times you chase 1 day's strength and you go right back down in that downtrend. So I'm in no hurry to run into Beyond Meat. You know, when you hit a short squeeze, it's not about fundamental data. It's about the insatiable demand that hits with limited supply and what that does in the short term. You know, Carvana did come out with a pretty good report and gapped up and took out a key short-term support level. I'll tell you what, if it gets up through 17.5, then you're going to see a whole lot of shorts. I mean, we might get some volume days up in the 100, 200 million range. So short squeezes are a crazy animal. And in our DMR, daily market report, I actually wrote about, I did a segment on it in the market report yesterday, just talking a little bit more about these because they are different. It's such a different trade than buying on a pullback. You don't buy these on a pullback. I mean, if you're looking at this and saying, well, my stop is going to be the prior day's low. And so let's say tomorrow it goes down to 1240 and you're looking at today's low, which is 1183. You could get in at 1240 and say, listen, if it goes below 1183, I'm getting out. But that's 60 cents. That's 5%. Are you okay with that? You might be stopped out in 15 minutes, losing 5%. But that's the kind of trades and kind of risk that you have to be willing to take on these short squeeze stocks. As more and more of these short squeeze stocks are starting to maybe develop, I started looking at the list more. So I'll begin looking at some of these others. I mean, here, this was Allo. Allo starting to move a little bit. Volume, look at the volume picking up here. You know, so that's one. It's 54%. That's the short percentage of float, 54.1%. SI, I'm not messing with. I don't care what the float is on it. This Silvergate, that shareholders, if they decide that it's over, you're going to get zero. You're going to lose your entire investment. So that one makes me a little nervous. NVAX, this is one I really thought yesterday, if we had finished above $9.50, $10, I thought that would have been a great finish. and we probably would have seen more strength. Instead, NVAX gaps up today and fails. This one still, in my mind, hasn't yet really triggered. We need to get this thing back, get that volume again, and maybe start breaking above $11, $12. And that would mean all of these folks would be underwater. And you get back through about 13, 14, it would mean everybody that's been in this stock since mid-December, anybody who's shorted would be underwater. That's when you can get quick moves from like 15 to 20. Not because of anything fundamental, just because a big wave is coming in the ocean and you happen to be out there with your surfboard and you just stand up on it and you got nowhere to go, but that wave's going to take you. And that's kind of what a short squeeze environment is like. You know, you can make a lot of money as a short-term trader very quickly, but you do have to be willing to take on higher risks. Anything else?
Yeah, let's squeeze one more. And somebody just asking, we can wrap it up with this one. If you could comment on TSN, Tyson.
Yeah, Tyson missed on their earnings the other day, and I saw the stock got hit pretty hard. It's been downtrending. It's in the, it's food products area, so it's a defensive stock. These are not the kind of stocks I'm interested in, but there is no mistaking the selling that's going on here with the volume picking up there. I don't try to catch bottoms. I mean, that's not my style. Some like to look at this and say, well, it's way overdone. And you try to get in, and next thing you know, you're down another 10%, another 12%. That's just not my style. If I was looking at it for a trade, at a minimum, I'd want to see some sort of reversing candlestick. Maybe a gap down where you trade way down intraday and you come back and you print a hammer. Then maybe you'll get a short-term little pop, but I'd be scalping and I'd be moving back to the sidelines. This is not a healthy stock. This is not a kind of stock I want to be stuck in. If it starts to turn lower again and I'm losing money and it breaks to a new low, I mean, losses can really mount in stocks like these. So if you're somebody who's looking at it from a valuation perspective, because you think it's just a great value, you go back on a monthly chart, 15 years, and you say, wow, we haven't been back here since the pandemic. And this 40, 45 area seems to be a great area. Now we're at 47. If that's your style, fine. It's not my style. So I will ignore it, and wait until it recovers and starts to show a whole lot more strength before I would be interested in it. Again, that's just the way I look at the market. All right, let's go ahead and wrap up. I appreciate everybody tuning in. Remember, next Wednesday, we're going to have the actual draft where we're going to announce the 10 stocks going into each of our portfolios for the next 90 days. I think this one's going to be a big one because this is the sweet spot for growth stocks from a seasonal perspective. I think growth is going up anyway. I think rates are coming down. And so that's where most of my focus is going to be. So if you want to know the stocks and you're not already a member, sign up for the 30-day free trial. Before the 30-day trial expires, we will notify you. I think a lot of folks are nervous about getting into, to try these recurring services because you're afraid, you're going to forget about it. Your credit card is just going to get hit. Hey, I'm the same way when I sign up for something. If I know my credit card is going to get hit every 30 days, but I can promise you, we don't want you to be a member here if you're not happy. And we will let you know before your 30 days expires to find out if you want to continue. So you won't have to worry about that. We'll make sure that we get back in touch with you. Check us out. We'd love to have you. Lots coming up over the next few weeks. And I believe a big bull market ahead of us. So with that, let's wrap up and hopefully see you all next Wednesday. Happy trading, everybody.